Good evening. It is time for today's Tax Talk. I'm your host. I'm attorney Stephen Leahy. It is Tuesday, Crypto Tuesday, March 8th, the year of our Lord 2022. And it is tax season, and crypto's a big part of tax season. So we're going to give you a 2022, it has to do with 2021, tax guide. Won't you join us? So we are here on Crypto Tuesday. Again, good. There's lots going on in crypto. It's hard to pick the right stories. We're going to review a couple of stories. Talk mostly about the taxes, tax guide. It is today's tax talk, but there are other issues going on with crypto, and we're going to talk a little bit about those too. The Ukrainian-Russian conflict. Some other countries have started accepting crypto for taxes. We've seen that before. It's not the first. I think that was our theme last week. I believe was the crypto firsts, and they keep rolling out crypto firsts. But let's start like we always do here on Crypto Tuesday with let's start with the markets. And here's the markets. Let's get it up there. We are here on our friends at coinflip.tech and their market, and we're watching the Bitcoin, Ethereum are up for the day in the last 24 hours. And so, but that's kind of, then we always look for last 7 days. Last time we visited together about Crypto Tuesday. And so actually down for the week. It's settling right now at 38,000 Bitcoin. Let's look at Ethereum. There's some talk about Ethereum overtaking Bitcoin as a number one. And again, like as most cases, I don't know how many weeks we came and they did not move together, but Ethereum and Bitcoin tend to move together. And here now Ethereum's at 2577.25. So it's kind of it's steady, little volatility. There's always volatility. Thought there'd be more upward pressure given the war, that the Russians are using these cryptocurrencies to get around the sanctions. The Ukrainians are using it to get out of the country, bring their assets with them. I've read a lot of stories about the Ukrainians going to neighboring countries, and again, they don't have to carry any gold or any belongings. It's in there. It's up in the cloud, and they can go get it. So they get into a neighboring country, and they can access their valuables. It becomes very important, right? When you go, trying to flee. And again, same thing with the sanctions in Russia. The Russian people trying to get around the sanctions by using crypto, since the ruble has been, targeted and is collapsing, and so crypto is giving them. So I thought there would be more higher pressure on crypto. But here's a story: Congress and the IRS make moves to improve taxpayer compliance for tax cryptocurrency transactions. I think it was a couple weeks ago I mentioned the executive order. They've been talking about this executive order coming from Washington. It's coming. They mentioned that it's probably going to be this week if they do come out, and it is monumental as they predicted. We'll probably cover it maybe a Crypto Thursday. And would not wait till next Tuesday, but we'll see what happens on that. So this is a pretty good article about taxes. IRS Commissioner Charles, I don't like to talk about him, testifying before Congress in April, estimated the gap between taxes owed and taxes collected in the United States and I quote this all the time, but you can't really find this anywhere, because the difference between what he says here and what they say now, or what they always said, is very different. So he says that it's close to $1 trillion. Now remember, this is in the midst of the Build Back Better, April 2021. March, they had passed the American Rescue Plan, which put into Venmo reporting requirements that nobody knew about. And then they were pushing for the Build Back Better. And part of the Build Back Better plan was to lower the tax gap. And so it went from somewhere like 200 billion, which is, usually the numbers are 200 billion, 280 billion, 300 billion. And all of a sudden it jumped to $1 trillion. While there is some debate as to how much lax reporting on cryptocurrency transactions contributes to the so-called tax gap, with the market capitalization hovering at the time of this writing around $2 trillion, well, then it can't have much of it, can it? Cryptocurrency investments have increasingly become an object of regulatory scrutiny, and we cover that a lot on the show. The regulators are after cryptocurrency. Beginning with Notice 214, this is when they recognize that cryptocurrency as a property. The IRS has consistently taken the view that cryptocurrencies are property for the U.S. federal income tax purposes, absent any specific statutory or regulatory exception. U.S. individual taxpayers are generally required to report gains realized on the sale of property, including cryptocurrency, and pay tax on these gains. To remind taxpayers of this requirement, and I've showed you from 2019, and the first time that crypto question appeared on Schedule 1 of your 1040, and then 2020 it appeared on the first page of your 1040 form, and now it's there again, a little bit different language. So that's what we're going to review here today. To remind taxpayers of this requirement, now Form 1040 now specifically asks taxpayers whether they have received, sold, exchanged, or otherwise disposed of any financial interest in any virtual currency. The instructions define virtual currency for this purpose as a digital representation of value other than a representation of a real fiat currency that function as a unit of account, a store of value, or a medium of exchange. Cryptocurrencies are included in this definition. The question on 1040 requires an affirmative answer of yes or no from all taxpayers. And again, you're answering under penalty of perjury, so you have to be truthful. A version of the virtual currency question was included on Schedule 1 of Form 1040 when it was introduced in 2019. But beginning with the 2020 tax year, the question had a more prominent position on page 1. At that time asked, at any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? The wording of the question has been modified for the 2021 tax year to remove the word send and replace otherwise acquire with otherwise disposed of, consistent with the IRS's focus on identifying taxable events involving cryptocurrency. Because it's not a taxable event if I acquire cryptocurrency, it becomes a taxable event only when I get rid of it. Now, it can be taxable, I guess, if I acquire it through my labor or selling goods, then it could be taxable. Generally, any transaction involving cryptocurrency during the tax year will require a taxpayer to answer yes to this question, with the exception of purchase of virtual currency with real currency with no further activity. Expansion of 1099B and 8300 reporting to digital assets. During his congressional testimony, the commissioner recommended that Congress pass legislation requiring information reporting for cryptocurrency transactions. The Infrastructure Investment and Jobs Act, this one passed, it shouldn't have, signed into law by the President Biden on November 15th, does this. Again, should never have passed. Under the new law, any person who, for consideration, is responsible for regularly providing any services effectuating transfers of digital assets on behalf of another person is a broker, for purposes of Internal Revenue Code Section 6045 and required to report those transfers to the IRS on Form 1099-B. This act defines digital assets as any digital representation of value which is recorded on a cryptographically secured distributed ledger or any similar technology as specified by the Secretary, except as otherwise provided by the Secretary. A broad definition with the potential to encompass range of crypto assets, including perhaps non-fungible tokens. I think for sure it does include non-fungible tokens. Failure to comply with this reporting requirement would trigger penalties under IRS Code 6724. This definition of broker, as amended by the Act, has been criticized by some members of Congress and many in the cryptocurrency industry as overbroad, as the language would potentially pick up other participants in the cryptocurrency ecosystem, such as miners and wallet developers, rather than merely cryptocurrency exchanges. A bipartisan group of legislators attempted to revise the language to address these concerns, but the proposed amendment did not make it to the final bill. While it remains to be seen how the U.S. Treasury, which will be tasked with implementing the new reporting requirement, will interpret the language, unofficial statements from the Treasury indicate that it will not seek to enforce this requirement against miners and hardware developments. Yet, my own opinion is I think they will, and that's why they always promise to do least and then do the most. That's just the nature of regulators. The Act also amends Section 6501 or 6050I, which generally requires taxpayers who receive over $10,000 in cash in the course of a taxpayer's trade or business to report this receipt to the IRS on Form 8300 to apply to receipts of digital assets. The new reporting requirements are effective for returns required to be filed and statements required to be furnished after December 31st, 2023. Okay, so right now you go to a place, you buy something on a credit card, it costs you $11,000. That's not you don't have to report that, right? Because that transaction's reported from the credit card company. But now they're saying, hey, if you do that, if you give cryptocurrency, that's like giving money, then you have to report it. And that really puts a damper on using cryptocurrency. The new reporting requirements are projected to raise an additional revenue of $28 billion over the next 10 years. Yeah, right. According to estimates prepared by the Joint Committee on Taxation, a sizable sum, though unlikely to make a significant impact on the tax gap. Other potential legislative, because to make an impact, then that has to be things that's not reported now. But many people do report it. Other potential legislative changes affecting the taxation of cryptocurrency transactions are currently under consideration by Congress in the Build Back Better plan or Act. We really have to object to this Build Back Better Act. They want to give $80 billion more to the IRS, more than double the employee size of the IRS. It's something we have to oppose, which was approved by the U.S. House of Representatives only to stall in the U.S. Senate. This would extend, now this is important stuff here, this would extend the wash sale rules of Code Section 1091 and the constructive sale rule of Code Section 1259 to cryptocurrency assets. Now pay attention here, this is very important. A wash sale is a strategy that effectively provides an investor with a tax-deductible loss while maintaining the position to an investment. So if crypto's down, I buy crypto, say I bought Bitcoin at 40,000, it goes down to 32,000. I sell it, I've taken a loss of 8,000, and I buy it back at 32. So technically I still owe the same amount, but now I've taken an $8,000 loss, and I can take that loss against other capital gains, even though I'm still holding the currency. That's what they're trying to get rid of. And it is an advantage. I'll give you that. Code Section 9 disallows immediate loss deduction in circumstances where a taxpayer sells at a loss and requires the same assets of something substantially similar within 30 days before or after the loss sale, but is limited by its terms to loss sales of stock, securities, and certain options. Because cryptocurrencies are not considered securities for purpose of these rules under current law, crypto investors have been able to obtain the tax benefit by harvesting tax losses during market downswings without actually cashing out of their investment. Well, they cash out, but then they can cash back in. The constructive sale rules in Code Section 1259 are intended to address the reverse situation. A taxpayer effectively liquidates an appreciated financial position without recognizing taxable gain. Under current law, disposing of an appreciated financial position in any stock, the debt instrument, or partnership interest in a short sale or futures of forward contract for the same or substantially similar property is treated as a constructive sale and therefore a taxable event. The Build Back Better Act would limit use of both of the wash sale and constructive sale strategies by cryptocurrency investors by extending application of these codes to digital assets such as cryptocurrency. It remains to be seen whether Congress will revisit these proposals in 2022, either as part of the Build Back Better Act or a standalone bill. However, the proposed changes suggest growing interest in Congress in closing what some perceive as a tax loophole with respect to these asset class. The changes to the wash sale and constructive sales rules discussed above were estimated to raise $16.8 billion over 10 years per the joint committee. It won't raise that much money because nobody will use it. As they say, well, if people keep doing what they're doing, then this would raise this much money. But if the wash sale rule wasn't there, then they wouldn't raise that money because people wouldn't do it. Just makes sense. So there's another good, let's see if I can get this. Huh. What's going on? So here's another good story. Cryptocurrency tax guide, filing your Bitcoin and NFT taxes. The IRS is cracking down on cryptocurrency tax cheating. Well, again, this is a good story from the Wall Street Journal. I recommend it. I'm not going to go into it right now. Don't have the time. Another good story. Cryptocurrency and Bitcoin tax guide. This is another one very similar. U.S. government has issued a cryptocurrency and Bitcoin tax guide for investors and taxpayers. Cryptocurrency to be accepted as currency in Swiss city to pay taxes and things. We've seen this in other venues. Another good story. How cryptocurrency is proving to be a two-edged sword. How do I get rid of that? A double-edged sword in the Ukraine war, as I mentioned earlier, kind of this because it supposedly can help both sides, and that's why it's a double-edged sword. And what the great thing about crypto is that it was supposed to be decentralized, that these regulators really couldn't have power over it. It would be a great disservice to the crypto environment and tax and investors and holders that if they were to just start. So, for instance, in Ukraine, they're suggesting that all Russians should be stopped from trading. Not just the government, but all Russians. And then how do you say who's the Russians? Do they have to be in Russia? Could they be in America? Can they be anywhere else in the world before you stopped it? And this is where it's getting into the problems. Same thing happened we saw in Canada when they debanked people. Well, it did a big blow to people, to their confidence in the Canadian banking system. Why should I keep my valuables in the bank in Canada if the government can arbitrarily just say, you know what? You don't have those valuables anymore. You can't buy food. You can't buy gas. We're taking it away from you. Well, that kind of shakes the whole system, doesn't it? My own opinion. A little editorial there at the end. So thanks so much for joining us here today. I appreciate you taking the time. As you know, I'm going to ask you to like and subscribe. We need to get the word out. We need to get our show out. We want your help. So please like and subscribe to our channel. We appreciate it. And remember, if you're fighting the IRS, no matter what the fight is, what you got to do, first thing you should do, and again, as a tax attorney, I can tell you, this is not legal advice though, but the first thing you should do, get a copy of my book, deal with your IRS problem today. Go to freeirsbook.com, freeirsbook.com. That's freeirsbook.com. Get a copy of my book, Deal with Your IRS Problem Today. Thanks so much for joining us here. I appreciate you taking the time. We're going to be back tomorrow, talk about more tax issues. I hope you can join us. So thanks so much, and we'll see you then here on today's Tax Talk. Out.